Why is it network? Yeah, they say we can. They say they can.
No,
Can you see what he said? Yes.
Huh? Very good afternoon to each and every one of us connected to this presentation today. My name is Asai Meshak, and I've here my colleague Bolanle Onawumi. We are both from Deloitte and here to present to you the ABC financial reporting for entrepreneurs. For the next couple of minutes, 3 minutes to be specific, I will give each and every one of you to get your connection very right and be ready for this section. So I will give each one of us 3 minutes to get us set for today's presentation. You are welcome to this section. So let us give each of us 3 minutes.
168.
All right, it's not end of 3 minutes. I want to welcome you all to today's presentation, the ABC Financial Reporting for the Entrepreneurs, presented to you from Deloitte. So this masterclass today will address us some of the basics in financial accounting and also bookkeeping to help you entrepreneurs to be able to account for your business properly. So, as I mentioned earlier, my name is Meshak, and I have here with me Naomi Bolanle to also present the second part of it. While the presentation is on, I will encourage all of us to post our questions to the chat box so that by the end of the presentation, we will be able to address your questions during the Q&A section. So, we want to go back to the main reasons why all of us are here today. As entrepreneurs, one of the key elements and one of the key factors you have to consider why carrying out your planning, you want to launch a product, and you want to allow your idea to get to that maturity stage is to have an accurate bookkeeping. And when we make bookkeeping, we are not making reference to the record being kept by the petty traders along the street. You understand that those ones don't keep appropriate bookkeeping, and they don't actually produce some set of financial statements. But today we're going to see why it is important for us to keep our books very correct and also progress in producing some set of financial statements. So we're going to be looking at the concept of bookkeeping at the duration of our discussion. We'll also look at the overview of accounting, as well as look at the set of financial statement that is required by the SMEs. We will be looking at some of the concepts around cash flow. And what is so critical in this discussion is your short-term financial management. We will touch base with budgeting and cost control and cost reduction measures. So with this, we believe that we'll usher you into how your book will be kept properly and also produce a set of financial statements. Now, bookkeeping means recording financial data, financial activities, keeping them in a way that it shows a way that you classify it such that you can be able to use it to prepare your accounts. So we don't mean that when you are keeping your books with regard to finances, it's not just all the activities that you carried out from when you conceived your idea or when you are project launch you're going to actually record. But we're talking about financial records, so something that has to do with your finances. So when you keep your book, the key objective you keep in mind is that the records will show a systematic recording of those transactions. If you're going to record an item of income statement, that is your income and expense, you must be able to record those activities in such a way that if you're going to capture them and reflect them in your financial statement, you should be able to classify them appropriately. So we want to see what form those records will be kept. You can have your register to keep some of those financial activities, opening your cash book and opening some other journal books to keep your record on how you transact, how you move around, keep your expenses with admin costs, with costs of your raw materials and all that. You can also use a system to capture this information as well. So the art of bookkeeping is the entry point of getting your accounting right. So if you don't keep your book very well, when it comes to summarizing your financial record, it will actually be very difficult for you. So what is accounting, we may ask? Accounting is actually taking it from book recording So when those transactions have been recorded in the books, you proceed to the next stage by classifying it. And after classifying, you have to summarize those transactions. And these transactions, as I mentioned, are transactions that are monetary terms, not just any transactions that happens within your business areas. So these three things are key: recording, which is the art of bookkeeping, the classifying of this information, and summarizing it. Then we can now talk about what those accounts will reflect at the end of the day. So why will you want to account for your business? So many statistics over the media or some school of thought have mentioned that for new starters like us, you we have high rates those business fails. Among those things that factor that could cause business to fail is how you price your product or your service, and how you keep your books properly. Because some of us might see revenue as income. So when you see those money coming in because your product is a bit well priced and you're making sales, some new entrepreneur will confuse revenue as income and they start dipping their hands into revenue, not knowing that you're actually eating up your capital. So financial information is very critical for you to analyze what is your real income, and also to know the financial position, because when you don't have an account statement, when you don't have set of financial statements, it will be difficult for you to make a decision. I'm sure the provider of funds to you, either you were able to mop up funds to start up your business, or you've this platform which you are now have given you some grounds. You will agree with me that for subsequent decision, for subsequent grant to be given to you, they want to see how the business is doing. So the set of financial statements will actually give you the health of the business, to know whether you have the ability to generate cash, to know your ability of generating revenue, and to know the income that you have made by the end of the day. So in every profession, in every business function, there are a set of principles that governs such professions. And when you break such principles or concepts, I mean, you know where to be found. You agree with me that today everybody is trying to get COVID vaccine, but when you look at the processes you're going to go through, the principles that must be kept, it's clear that you still have a long way to go. So we want to look at some of those principles that are governing accounting that you must comply with. Among those ones are core concepts. Now, core concept is telling us that for you to recognize your revenue, that revenue item must be earned. So let's say, for example, you are into production of bottled water and you want to make sales. So when you receive that inflow, you want to register it as, you want to post it as part of revenue. But you agree with me that sometimes customers could make deposits against future sales. So how do you account for that deposit? You post that deposit as part of your revenue. Is that advance deposits to be registered as revenue? No, because at that point, a sales has not occurred, and you can't regard that as part of the revenue that have been earned. So our core principle is telling us that for an item of revenue must be earned before it's being brought to book. And expenses are only recognized in the period that they occur. So I will also take us to the matching concept. The matching concept is telling us that, look, we must aggregate a related expenses and revenue together. So it means if you have made some purchases in your book and you want to determine your cost of goods sold, the costs that are attributable at that particular period must be matched with a related revenue. That is the only way you can be able to come up with the profits you've earned for the period or the actual revenue you have made for the period. So you have a lot of accounting concepts and convention that you must comply with. We also have a going concern concept. Going concern concept is telling you that, look, the account is being prepared with the mind that the business will continue in the foreseeable period of time. So it means you can be able to defer some expenses, you can defer some liability, you can make some credit sales, and do not actually do cash accounting, because you know that in the next period, those credit sales you have in your receivables will be realized. So in preparing your account, you don't want to prepare it in a cash basis, as you have seen from the Accra principles. So when you make sales, you don't want to only recognize the cash that you receive as your revenue. That's also part of the Accra principles. So you receive the cash, the credits you have also, the sales you have given in credit, you're also going to recognize it as revenue in your books at that particular period. So do not keep credit sales off your revenue, because you are not just regarding only the cash sales as part of your revenue. So we must put that into consideration when we're preparing our accounts. So why is the need for accounting? Accounting is actually needed for there are so many parties that are interested in accounting. A lot of organizations today that want to increase their equity, and they need prospective investors to either become to invest in the entity or to give out some form of debt capital. We demand to see the set of your financial statement. They want to see your profit or loss. They want to see your profit, the statement of financial position, which is your balance sheet. And they also want to see your cash flow statement and notes to the accounts. They need these information to be able to make such decisions. And what about your internal employees? They're also interested to know all these informations. What about the statutory, the regulatory agency? All these parties are interested in getting to know the status and the health of the organization. And the only way they can know that is through what? Is through getting your financial statement out. Now, the difference between the bookkeeping, as we earlier mentioned, is we said that the bookkeeping consists of record financial statements in a logical fashion, and the accounting also uses the record you have also put in your books, summarize it, and prepare a set of financial statements. Now, we want to see the objective of financial statements and some of the various components of financial statements. One of those components is your assets. So when you pick up your statement of financial position, the three key primary financial you're going to see there is your assets, your liabilities, and your equity. And what again you're going to see is your cash flow as well. So these are components of financial statements. And we've also said that the source of financial statement comes from your recording of your invoices, your receipt, your vouchers, debit note, your credit note. All these are various sources of your financial statements. So when you have all this, what happens? You are going to raise a journal. A journal enables you to pass the debit and credit entry to your ledger. So the ledger will warehouse all the financial transactions, and then you can use that to prepare your trial balance. So when you get your trial balance, you can now proceed to prepare your financial statement. So this is just a first step way you are going to flow from your source document to your journal entry, from journal entry to ledger entry, and then you get you get your trial balance. So when you have your trial balance, you can now progress to prepare your financial statements. So I've earlier mentioned these 6 components of financial statement: your statement of financial position, which shows your assets, your liability, and your equity. And we know what the asset means. Asset means what the business is, what belongs to the business. The liability means what does not belong to the business. And your equity also means what the owners. This is the owner section of it. So you must represent this. And we have your statement of financial position as well. Then you have your cash flow. In the next section, we're going to dwell more on cash flow. So we are going to take us through some of the basics quickly. Some of those features we see in a financial report, so that at the end of this session, when you go over the internet, you can actually access full financial statements of entities cutting across various industries. So for any given financial report, you are going to see the name of the reporting entity. You're also going to see the date that particular financial statement is published. You are going to also have some level of reporting currency, and you also see the rounding in terms of the value of the currency that was used. So for example, if it is Naira and you are not giving absolute figure, you're also going to let the user of financial statement to know how you have rounded those numbers. Now, what you are seeing currently is a sample of an income statement. So I've mentioned about how you recognize your revenue, which is your sales, your cost of goods sold, and all that. So at the bottom part of it, you get your net income. And what is currently being displayed is your sample of balance sheet. You have your assets, and you have your liability and your equity. So just have it at the back of your mind that you need to keep your book very well, such that you can be able to pass journal. And when you take in your journals, you'll be able to recognize your ledger entries. Your ledger entry will lead you to what? To your trial balance. And with the trial balance, you can prepare set of financial statements. So I will now invite my colleague, Naomi Omobalali, to take up the next section on cash flow statement and business milestone.
Thank you, Meshach. Thanks, everyone. This session basically helps us understand the role cash flow statements and management of cash flow plays in the business framework, especially for entrepreneurs. Cash flow management is a very critical exercise that must be done to ensure the going concern status of the entity is sustained. So the way I would want to go about this is to first introduce us to the main components and the definitions that we really need to understand so that we can take it forward. So cash flow would definitely be either you have an increase or decrease in the amount of money within your business. And then for you to be able to appreciate and analyze this amount properly, there is need for you to prepare what we call a cash flow statement. A cash flow statement basically helps to summarize the sources and the utilization of cash within a business in a format that the owners and the other people that are making decisions on this amount can make constructive decisions. So the statement of cash flows would basically have 3 sections, and those sections are as follows. One, you would have a section that covers the operating activities of the business. Then you have a section that covers the investing activities of the business, and then the financing activities. The reason why you have to categorize all your cash flows, both inflows and outflows, into this category is to ensure that you understand the source and then how funds have been utilized. So your cash flow from operating activities are basically all amounts that enables you to continue the normal operating activities of the business. So you have cash flows from customers, you have cash flows to vendors, cash flow paid to employees. This typically reflects all the normal business operating activity of the business. Now, you also have what we call cash flow from financing activities. That has to be segregated and separated from cash flow from operating. So the cash flow from financing activity means that you have gotten funds to boost up the capital of the business. So the cash flow from financing activities are funds from investors, from banks, from lenders, all sort of lenders that you have. So the cash flow you receive from that source, you need to manage it properly to ensure that you are able to pay the return required, or the return expected from that cash flow. So for a lender would have pre-specified the return expected from the cash flow he has provided to the business. So you must manage the cash to be able to pay back that return. A shareholder would also expect certain returns from the business. So you must manage every cash flow that comes in from shareholders to make sure that you are able to give them adequate return, and that would help to ensure that the business continues as a going concern. Then you also have cash flow categorized into investing activity. So you see the cash flow from investing activity stems from both the cash flow from operating and the cash flow from financing, because the cash flow from investing means that you are ensuring that there is continuous ability to operate within your normal course of business. So when you have excess cash in the business, you invest it in bonds, you invest in fixed income securities, you invest in equity, you invest in additional machineries, you do maintenance work to ensure that your business is able to continue to generate cash flow for operations. So the investing activity over time actually determines the extent to which the operating activities would continue. So if you have a situation where there is cash inflow from financing activity, you've borrowed money or you've gotten funds from shareholders, and you are not putting it into investment activities, there would come a time that you will have a shortfall in your cash flow from operating. So they are all linked together. So a statement to help understand this is very critical. And then for all stakeholders and for us financial analysts, we look at your statement of cash flows and we can make predictions about the health of the business at every point in time. And then the next changes that you have just talks about how funds have moved from each of these major areas for the period that we are looking at. So that's essentially what a statement of cash flow helps you to do. Why do we need to pay attention to preparing a cash flow statement? It's because, like I mentioned, it's a short and long-term planning tool. So if you always have a situation where you have negative cash flow from operations, it means that you are stuck within your supply chain system. Your accounts payable processes are sucking up cash that is not being released in form of receivable from customers. So you use that tool to be able to analyze the health and then plan the funds of the company. Another thing is, with a statement of cash flow, it's easy for you to immediately identify whether there is excess cash in the business that should be invested, or there is room for machinery upgrade, or for funds to leave the major activity and go to other other activities that could strengthen the business in the long term. So you could have funds to have more business acquisitions, or to procure new machineries. This helps you to be able to analyze that. Then also you are able to know how much money you're spending. It helps you to understand how much money is being spent and on what. Are you spending more on operations? Are you spending more on financing staff costs? Are you spending more on financing office spaces? It just helps you to understand where the cash is going. And then, of course, very critically, it helps you to analyze your working capital. Now, it's very important as a business unit to be able to separate cash flow from income statement, and to be able to separate statements of cash flow from statements of income. Your cash flow talks about the in and out of cash in the business, but your income statement measures your performance over time. Your income statement summarizes how your revenue that you have made has translated to profit or loss in a given period in time. And so that the profit or loss you have in your business, it's a summary of the revenue, your allowance for depreciation, the employee cost. So it has both cash elements and non-cash element to ensure that we are able to track the performance of the business, not only on a cash basis, but on an incurred basis, meaning that you're able to track everything that has gone into the business. So the statement of cash flows is different from your income statement, and that is why, as a requirement of international financial reporting standards, when you prepare a statement of cash flow, you also prepare a statement of profit or loss and other comprehensive income, and you're able to also reconcile your profit to your cash flow, because you can have a situation where you are profitable but then there is no cash, and you can have it vice versa. So that helps you to gauge and understand what cash flow is and what income is. So there are various techniques that you can then adopt to ensure that you are not cash trapped as a business, especially as a reflection of what your statement of cash flow is telling you. So in your operating cycle, you could find a situation where your cash flow from operations is negative. When you have that situation, there are some machineries that you can put in place, some techniques you can put in place to ensure that you reverse that trend. And one would be that you can accelerate your collection of accounts receivables. Maybe the average credit period you're giving to customer is too long. You can consider shortening it or making your business to be more cash focused. And then for your accounts payable as well, you can look for ways to stretch the accounts payable processes. You find that most organizations would typically have a payable cycle of 30 to 60 days to make sure that they are able to turn around the monies that are tied in inventory before they pay their vendors. So these are all cash flow management strategies. Another way to manage your cash flow would be to ensure that you have very good relationship with your banks and you're able to assess the financial market at every point in time. And of course, to be able to do this, you must reflect over time your transparency in reporting. And that's why Meshach has taken us through a session where we must ensure that we have proper records and proper books to ensure that you're able to give confidence to the outside world on the strength of your business. And of course, regular monitoring of the cash in and cash out is also a critical cash flow management technique. I'll take us through some of the key highlights of short term. So we cannot, because the course is very short, we cannot take you through the entire gamut of the financial management, but just focusing on the short term financial management processes that you can have. That would be your cash management, your working capital management, and your credit risk management. These are very, very critical elements of your financial management. So taking us through cash management, I think I mentioned around how you can optimize the cash management cycle, and that is ensuring that you have you are able to define your account receivable period, your accounts payable period, your inventory period. So sometimes you have a long inventory gestation period depending on the products that you have. So how to make sure that you are shortening the process of, the production and then the remittance of eventual cash. It's a very critical technique to ensure that the operating cash flows are maintained or even boosted. Now, for your working capital management, that's also a very essential area of short-term financial management. You have to ensure that you're not using short-term finance to finance, long-term projects. And so a proper classification of your assets into their type and your liability into their type is very critical. You must be able to identify what a current asset is, that is an asset that you must utilize or that you would realize its value within 12-month period. And then a non-current would be that you cannot realize the value of the asset within 12 months. So your properties, your plants, your equipment, those assets don't have values that can be realized within 12 months. So the cash management technique for those would be that you're seeking to get long-term finance to finance those assets, and your current assets are financed within the normal operating cycle of the business. Your current liabilities are liabilities that fall due immediately. So your immediate liabilities, immediate obligations that must be met. So what it then means is that you must have sufficient current assets to be able to meet your current liabilities. And then you have to do this whole process by making sure that you're tracking the relevant ratios and making sure that your working capital to current ratios, your collection ratios, your inventory turnover ratios are optimized at every point in time. For the other bit of things, it's the credit risk management. So the way to ensure that you don't run into financial problem with your customers is to make sure that every customer you are dealing with to a very large extent has some basics of credit worthiness. And as an organization or as an entrepreneur, you need to start developing processes to make sure that you are able to analyze your customers and put them into categories that they belong to, so that you don't give too much to a customer that does not have the ability or the willingness to pay at any point in time. There's something called the 5 C's of credit that we look at in credit risk management. We talk about capital, we talk about character, we talk about collateral, and then we also talk about capacity and condition. These 5 elements are very important, especially as you deal with customers, because you must be able to analyze the ability of your customers to pay as at when due. So the capital, character, collateral all speaks to the ability of the customer to pay you back, and then the willingness of him to do so. Character talks about the willingness of the customer to actually pay as at when his obligations fall due. I can't go into the details of all of this, but I mean, just an awareness of this concept and the ability to integrate it into your financial management practices. Now, cost reduction and cost control is another essential element that must be looked at. So for you to be able to manage cost, you must first of all understand the structure of the cost that you are incurring as an organization or as a business owner. And then once you understand the cost structure you have, you can then now have devices in place to control costs or to reduce costs or to allocate costs. So if I would just look briefly about the cost structure, you have cost structures that, I mean, there are varied ways of categorizing costs, but for this purpose of this presentation, I'll just talk a bit about 5 of the cost elements that you could have. You have fixed cost. Fixed cost means that there is no part of your activity level that can change that cost. So whether you are producing at 100% capacity or at 20% capacity, the cost has already been incurred. So no change in activity level can influence that. So for your fixed cost, this has to be tracked holistically to be able to ensure that the variable element of your cost can absorb it. So you have variable cost you can control, because the level of activity you're carrying out would then determine whether the cost is huge or the cost is low. At a minimum, I mean, your variable cost must be covered by the revenue you expect to get. Then direct costs will be the costs that are directly attributable to a product or a service, and that direct cost could be maybe the labor that you need or the employees that you need to run that service. The cost they incur is direct to that service, so it's proportional. Such cost has factored into the pricing of that product, because the cost is related, it's strictly for the products that you have churned out. Then indirect cost would be an opposite of your direct cost. So the cost that you cannot trace to a particular product, but of course, for you to continue to sustain your business environment, you still need to incur such costs. So such costs as your general advertising, branding. These are costs that are indirect costs, but of course they are necessary costs that should be incurred. Marginal cost concept, it's an economic cost concept that we use, but for accountants, we don't really analyze this, but it's a very important concept in also managing your cost behavior, because your marginal cost looks at the additional cost that you must incur to get further work done. So you compare that to the additional benefits that you expect to get if the cost is incurred. So these are the structures of cost that I'm able to take for today. And then how do you manage cost? Right. So you manage cost through several processes, but I'll mention three for just at the basic level. Budgetary controls is an essential cost management technique. It means that at the beginning of the life of any project, or at the beginning of the year, you make a budget. You do a budget of what you intend to spend on, and you ensure that over time you track that budget. You see how you're doing in terms of the actual expenditure and the actual inflows that you're getting against the budget. That helps you to track costs and monitor it. Another way is standard costing. That's for those of us that are into production. Standard costing helps you to understand the various elements that go into a production cycle. And so when you are exceeding your standard cost, you already know that there is need for you to analyze the variance and see whether those variants can be curtailed, or you have to absorb them into the next reporting cycle. Material costing would also be a useful tool in terms of cost management, to help you know the actual quantity of materials that you actually need to be able to produce the level of quality of output that you expect at every point in time. So we're not able to take more than this at this point, but we would now respond to the questions that you have posted on the platform. So if I go through some of the questions that we can see, someone asks that please briefly explain the roles that budget and cash flow projections play in business for setting direction and managing business risk. Yeah, as we have mentioned, I mean, budget and cash flow projections are very useful cost control techniques that you can use in managing your business. If you have a budget, it's more likely than not for you to be able to track, you know, the inflows, the inflows and the outflows from your business. So if you're able to track those, you're able to see over time how your business has fared, and then you're able to identify the cost drivers and address those cost drivers as much as you can. So budgeting and cash flow projection, very useful in managing the risks that are inherent in your business. There's a question that says, please clarify the difference between revenue and income.
All right, to clarify the difference between revenue and income, you notice that the total income generated for a given period we can classify it as your revenue. But you understand that in generating that, you have incurred costs to generate that revenue. So to know the net income for that period, you need to deduct the associated costs or expenses to generate that revenue. So when you now do that, you will not have a net income or a net profit. So if you want to take case of a manufacturing business, let me use water. You are into water production. You must have incurred costs to get your plastic PET bottles, your admin costs, and all that. So you have your direct costs, you have your indirect costs, and so you need to determine all that to come up with your cost of goods sold. When you deduct that from your total revenue generated for the period, you're going to get your gross profit. But mind you, you have also incurred some other costs in your distribution, your selling expenses, some discounts you have given. All that as well will be considered in line with your admin costs. So when all that is determined, your true income will not be your net profit. So that is the actual profit that you have made for the period that will flow to your equity. So that's the difference. So one is gross in nature, while one is net. So revenue is the gross income you have made for the period, while your net income is the actual income after deducting the respective expenses, respective costs that have been incurred in a given period.
So how can financial reporting and recording help your business to expand and attract large investments? I think this is a very useful question. Financial reporting, that's the only way you communicate the status of your business to outsiders. So if you're making a claim that, oh, my business is very profitable, my business is a cash-driven business, there is no other way to communicate it to a stakeholder if you do not have quality financial reports. So financial reporting is the tool, is the basic tool to communicate the status of your business to the outside world. So the quality of that financial report then helps you to attract the kind of investment, attract the level of attention that you want for your business. So you cannot undermine the role of financial reporting in attracting large investment. And the beauty of it is that quality financial reporting is what you actually need. So quality financial reporting into today's term for current international need has to be either be in international financial reporting standards or in the US GAAP. So that's a very critical way to project yourself to the investors. Then there's also a question about, is it advisable for a small business to outsource their accounting? Yes. Is it advisable? Yes, it is advisable if you consider the pros and the cons. The pros for outsourcing is potential cost savings. You're focused more on what you have the capacity to do as a business. You're focusing more on the core, and then somebody else who is more experienced is taking care of the accounting side. So in terms of compliance, in terms of controls, in terms of cost, in some instances, you're able to save on all of that. So it is advisable to outsource after you've considered the pros and cons. Speaking of shareholders, is there any formula you can recommend for giving or sharing of dividend?
Okay, formula to recommend, if you go by dividend policy, it's actually the owners that will sit down and during the board AGM or board meeting to decide what dividend that will be proposed. So it is you, the owner, the entrepreneur, the owner of the business that determine that. Because another thing that will guide you, if you are just a growth company, you need to also consider the level of plowback, the level of retention, so that you can expand, especially if you don't have enough muscle to attract much investment from the external world. So your business can generate much revenue. You want to retain as much as possible when you are starting up, so that you don't just pay out everything to the owners. So you get to that level when, for example, if you look at some blue chip companies, most of them make a huge dividend payment. That's because now they have enough revenue, they have enough cash, and they can do that. But as a starter, you will only just be advised to be very careful with the rates of dividend payout, your decision you're going to make.
Yes. Then another question is, most organizations do not publicize their financial statements online. How do we assess these documents or other quality income statements of interest that we can use as a model for our businesses? I think for this one, what you can leverage is what applies in the Nigerian Stock Exchange or the stock exchange of your country. Those entities that are listed on those exchanges, they are compelled to make their financial statement public. So if you go to their website, you will find their financial statement, or if you go to the Securities Exchange Commission website, you'll be able to see the financial statement, or the Nigerian stock or the stock exchange, you will be able to see quality financial statement that you can model. Another question says, what are the preferred measures a business needs to take to prevent negative cash flow? Also, how can a business recover from this if it occurs? There are lots of things to do to avoid negative cash flow. A lot needs to go into the process for you to manage negative cash flow. One, I mean, some of those things we have already enumerated during the presentation. It's about making sure that your receivable cycle is short, your payable cycle is longer than your receivable cycle. You're able to also make sure that you're not funding long-term projects with short-term funds. And also, you're also making sure that you have tested the credit rating or the credit worthiness of your customer, so that your cash flows are not impaired or are not threatened by their inability or unwillingness to pay. It says, how do loan and depreciation affect cash flow? So depreciation is a non-cash item, but it's an essential item to monitor performance. And so in your income statement, you would always have depreciation. So you always reconcile your profits before tax against the depreciation that has been charged. You had it back because it's not a cash flow item. But loan is actually a cash flow item, because when you obtain a loan, you're either collecting money, or when you're paying back the loan, you're paying cash. So it's a cash flow item. So depreciation is generally not a cash flow item. So you always adjust against depreciation when you want to determine your actual cash flow. Then we have a question from Olayinka, who says that, is office rent cost an indirect or a fixed cost?
Okay, so answer to that is an office rent is a fixed cost. The question is, what difference between a fixed cost and a variable cost? Variable costs vary with your production, but the fixed cost does not vary. So whether you produce or not, you must incur it. One of the examples of those expenses when you are setting up your business, your business place, is to rent either an apartment or to get an office place to work. And before you even start production, you have started incurring it. So whether your production increases by 10 or by 20, that doesn't change the rent you're going to make or you're going to pay by the end of the year. So we can say we classify your rental payment as part of your fixed cost.
How would you manage gross profit and net profit?
So your net profit, as we said earlier, is after you deduct your cost incurred. So if you want to manage it, yes, you can have a very big gross profit. But when you have spent so much money in distribution, let's say you are in your business is located on the island, it means you have to spend so much cost on transportation, you have to spend so much cost on admin. So that could actually reduce your net profit. So you have to be very careful how you go around planning your other costs that are not directly attributable to the production, so that the percentage of your admin and other operating costs will give you a better profit. So all based on planning, and that is why, as my colleague has mentioned, through your budget planning of your financial statement, you should be able to determine how you will be able to manage your cost structure to give you a very good net profit.
Okay. Any tips for how I can manage my inventory? It's a very broad question, but basically the concept of inventory management actually starts from the supply chain, how you get the resources that you're using or that you're using to produce what you want to sell, or whether you are an on-demand salesperson, meaning that where do you procure do your procurement from. I mean, procurement or supply chain management, it's an essential part of inventory management. Then the next thing to consider would also be storage costs, warehousing, transportation. These are all costs that have to do with your inventory. So if you manage inventory from a procurement side, you also have to look at it from warehousing, transportation, speed of delivery to customers. A lot of things go into inventory management. It's a very broad area of discussion, but I hope I was able to answer a bit. How can I control my marginal cost? So your marginal cost is the added cost or the additional cost of producing an additional item. So basically, your marginal cost, I expect, will be lower than the average cost that you incur, because there are some costs that have already been incurred. So it's just the added cost of making an additional product. So marginal cost can be controlled by looking at the cost element of that additional cost. So whether it will take you additional labor or it will take you additional raw material, you then look at it that how am I able to price all of this in an optimal way such that my total marginal cost is reduced from my average cost of production. So marginal cost is, I mean, you can control that by looking at each of the cost elements that is involved in an additional production. How do fixed costs affect a non-producing organization? So fixed cost is not just the machinery or the space that you use. If you have employees that are fixed term employees that have been employed, they're fixed cost to you, because it means whether you're producing or not, you have to pay salaries. So it's not necessarily associated with producing, as long as you have costs that you must necessarily incur in a particular period, regardless of whether there is production or not. It is a fixed cost to you. How do I manage cash flow without stress?
Yeah, how you can manage it without stress. This is one of the examples. I mean, to educate you on how you can do that. So, because as the owner of this business, you definitely need to have the broad perspective of your business, not just the products you want to produce or the services that you want to render, but you also need to understand how those money comes in. What are your payments? What are the inflows that comes? Yes, you can get somebody who is an accountant who can help you to organize this, but I will advise you to understand it. If it means taking extra classes, extra lectures, or extra whatever measures, just understand what is going on, so that even though you have contracted somebody to do it for you, you are not just nobody. You're just going to treat you as maybe as a rubber stamp. You should understand your inflow and outflow. So you can get somebody to help you do it, but you must make out time to understand how to plan your cash flow.
Our check says, how can we effectively keep records of inconsistent cash flows or unexpected expenses? Is it possible to do it in case of day-to-day money management? Yeah, I mean, that's the essence of having a budget. Once you have a budget in place, it helps you to track and be able to see the costs or expenses that you are incurring that are unexpected or inconsistent with your prior expectations. So I think the best tracker for this is for you to have a budget in place, and then you track your budget performance over time. Not depend on where you can do this and do it on weekly. I mean, the timing is dependent on the frequency of activity in that business. There is no best practice. It's just best for you to, at every point in time, to know what variances you have against your budget. Somebody asked a question to say, please, what accounting software do you recommend for an SME?
All right, at this junction, there are a lot of accounting software you can actually use as an SME. That depends on how much you have. So when you go over the internet or go through, there are a couple of them. I mean, the names are endless, but it all depends on what type of business are you into, and some of these softwares come with costs. You also need to determine, based on your plan you've also put in place, how much can you afford. So there are actually a lot of them that all of them are very useful, but depends on the type of business you are in and how much you have budgeted for it.
Okay, so I think this is about the last question that we can take for now. If you have further questions to ask, please send them to inquiries@tonyelumelufoundation.org. We would send our response to those questions via that platform. It's been a good time sharing our knowledge with you. I hope you found the session useful. Thank you very much.